So the question we're addressing today is really a question that investors have put to us. So we have discussed with pension funds, especially pension funds in North America, that basically put this question to us. Well, we understand that we are exposed to different macroeconomic factors when we hold an equity portfolio. And, can we, identify this and also do something about it? So can we actually target exposures in our equity portfolio as opposed to just accepting, the exposures that, implicitly we get from choosing active managers or, tilting to certain factors, tilting to certain sectors, etc. So really the question they had for us was, can we actually target these macro exposures in our equity portfolio? Now, it turns out that the answer to this question is not straightforward. So targeting macro exposures is quite difficult to do. So there's lots of measurement challenges. There's lots of challenges in actually, getting reliable investment results when you try to do that. So the answer is not straightforward. And what we will present today is really our solution to address this question. So we will present a way to actually target macro exposures. So these research results are all published in this paper that just appeared in the Financial Analysts Journal. And of course, you can go to all the details there. So we'll just provide you with really an overview of the methodology and the results during this presentation. So, to start off, let me just go to the the basic motivation. So of course, investors typically do care about the macroeconomic risks when they invest in equities, right? And what we're basically looking at here is really what are the tools that investors actually have to choose these macroeconomic risks, to target their portfolios. And so, why do investors actually care about macroeconomic risk? Why would they benefit from targeting certain exposures? Well, that's simply because investors may have two different objectives. One could be they want to offset some existing exposures. Okay, so let's say, for example, you're a corporate pension fund and your corporate plan sponsor, may have income that is highly linked, highly dependent on aggregate credit conditions, let's say, so would really suffer in a deep recession. Well, then maybe you want to think about that inside your equity portfolio. So you're kind of exposed through your income risk to macro conditions. Maybe you don't want to take the same exposures in your equity portfolio. A totally different objective could be investors could have views. So if investors think that, for example, the market is exaggerating on inflation expectations, inflation may actually turn out to be much lower than expected, they may express a view in their equity portfolio. So investors could have these two types of objectives. We're not going to go into exactly what these objectives should be, what exposures exactly investors should target. That clearly depends on the context. What we are looking at here is clearly for a given set of objectives, how do you actually measure these exposures and what are the kind of tools that you can use to actually target them. So our objective here is really to provide some measurement tools and some implementation tools for how you can actually target a set of exposures that corresponds to your objectives. Now, so this seems in a way like a modest question. So we're not promising any alpha improved returns or anything like that. We're simply trying to figure out how you can actually get the desired exposures in terms of macro factors. Now, as I mentioned, it turns out that this is actually quite hard to do, and there's lots of negative kind of evidence on that question. I'll just review a few reasons for why this is hard, and I'll just also provide you with some evidence on that. Now, this fact that this was difficult, we experienced this kind of in the early stages of our work on macro exposures. So we had actually done work, going back many years, where we're interested in, documenting some macro exposures. So we published an earlier paper in the Journal of Portfolio Management in 2019, where we're documenting macro exposures to, of equity style factors and factor investing strategies. And so we think, we did a thorough job in actually documenting these exposures. So following that, we were interested in, coming up with ways of targeting these exposures, for example, in multi-factor allocation. And actually, these approaches totally failed out of sample. Okay, so you could you could kind of document the exposures to the macro factors. You could also create portfolios based on these exposures that would look nice in sample. But once you actually went to an out of sample setting where you're kind of using the kind of estimated exposures to actually make decisions going forward, there was basically no reliability. So that was kind of one concrete way where we actually learned, well, actually it's difficult to actually implement these things. We also had conversations, and I still remember that when we started this project. So I discussed with a colleague who's the head of quant research in a different firm, in an asset management firm, and he basically said, well, I'm not sure you should make a lot of effort and spend a lot of time on this, because I think you're not going to be able to actually measure these macro exposures. Maybe you should just allocate your resources to something that is more realistic and kind of more feasible. Of course, what we thought is that we should investigate this thoroughly, and if at the end we find out that you cannot target macro exposures, that's going to be an insight. But there should be maybe some improvements that we can test, and it turns out that actually with these improvements we can show that we can reliably target these exposures. So let me show you some evidence that targeting these exposures is hard. So here you have results from a paper that was also published in the Financial Analysts Journal, so by Ang, Briere, and Signori. Now this paper looks at inflation exposure as just one type of macro exposure. Okay, so it's just an example. And what you see here is, they show the actual exposures that you get, out of sample. So once you have estimated exposures for different stocks, you then, what they do here is you, group stocks into different portfolios. You have the portfolios with high inflation exposure, and you have the portfolios with low inflation exposure. And what you have here, so Q1 is the highest inflation exposure stocks, and Q5 is the lowest inflation exposure stocks. And now what they do is they just look at, after you do this exercise, so you look at these stocks, you measure their exposure to inflation, then you create these portfolios, and then you just see what happens when you hold these portfolios. And what they show is that Q1, which is the high exposure portfolio, actually has inflation exposure that is very close to zero. And Q5, which is the group of stocks with low inflation exposure, also has inflation exposure that is pretty close to zero. So if you look at the key statistics here that are shown in below the estimates, they're way below standard thresholds of statistical significance. So basically, these exposures are indistinguishable from zero. Even if you look at the magnitudes, so you can see that the low inflation exposure stocks have an exposure of 0.95, whereas the high exposure stocks have an exposure of 0.06. So basically, you see that if anything, you can get the opposite effect. So the high exposure stocks actually turn out to have lower exposure. Okay, so even this very modest objective that when you actually identify stocks with high exposure, you expect them to have higher exposure going forward than the low exposure stocks. Well, that actually doesn't turn out to be true in this setting. And now if you go to this paper, they have another whole list of surprising details about this. So what they show also, for example, is that the exposures, quite often they change sign. So if you look at the stocks that have a negative exposure, that exposure turns positive when you go forward. So that just suggests a total lack of reliability. And that's probably also, this kind of result is what leads maybe, people to say, this is just very difficult to measure. Maybe you shouldn't even be trying it. Now, let's just replicate some of these results. So we're looking here at long-term evidence on macro exposures in the US. And we're doing something very similar here. So we're looking at inflation, the consumer price index, but we're also looking at production growth as another popular macro variable. What we're doing is we're just measuring the exposures to these macro variables. Then we're building portfolios, so these long-short portfolios that go long the high exposure stocks and short the low exposure stocks. And again, the kind of modest objective that one should have is when you do that, you would actually find that you actually get that targeted exposure. And here too, it turns out that no, you do not actually get the desired exposure. So if you look at targeting industrial production growth, so that portfolio of stocks that you identified as high exposure, you go long in those, and you go short in the stocks that you identified as having low exposure. Well, out of sample, it turns out this portfolio actually has an exposure to production growth, which is very close to zero. Okay, so it's actually slightly negative, but it's basically indistinguishable from zero. So what you would expect is to get a strong positive exposure that is also significant. So basically a t-statistic that is at least 2. And for the consumer price index growth or inflation, you actually get the same result here. So you're just not able to reliably capture this exposure. So if you just look at the evidence, there's lots of kind of negative news on that. If you look at investment practice, it's also fair to say that there doesn't seem to be any kind of convincing and readily available solution for this. So clearly, when you look at the industry, people do try to orient portfolios, equity portfolios, towards different macro scenarios, different macro variables. But when you look at how this is done, there's several problems with that. So there are kind of several ways of doing that, and each of these ways has a problem. So one very common way is, for example, that people use what we call off-the-shelf building blocks. So standard building blocks, like industry portfolios, you allocate to utilities versus technology, etc. And that's a common approach to target macro exposures. Some people also do this with equity style factors. So you will hear claims about value and size could be used to target some macro factors. Now, the problem with all of this is that, of course, none of these building blocks have ever been designed to actually target any type of macroeconomic risk. So, if you're lucky by accident, yes, you might be able to use these building blocks to target macro risk. But, at first sight, the industry classifications, for example, have not been designed to reliably capture macro risks. Certainly, equity style factors have not been designed to capture differences in exposure to well-defined macro factors. And so in a way, it would be surprising if these building blocks would be able to do things that they were actually not designed to do. Also, a lot of approaches are quite discretionary. So when you look at any investment product that claims to actually target macro factors, quite often it is a discretionary active product. So that also means for us, we can't actually replicate these approaches. You can, of course, trust the manager that he or she has the ability to target the desired macro factors, but you don't have the full information on the process. You cannot replicate it. It's not transparent. And then the final point, of course, is people do use derivatives to target some macro risks. This, however, doesn't really help in the context of equity portfolios. Of course, you can get any desired macro exposure if you have a corresponding derivative on that, say inflation derivative or interest rate derivatives. But if it's about actually orienting the exposure of your equity portfolio, well, you would still have to figure out in the first place what your exposure is and then how to exactly correct that. So with these derivatives, you would get very kind of well-defined exposure in that derivatives component, but you might actually overshoot, for example, if the exposure of the underlying equity portfolio is different from what you had estimated. So you cannot actually use derivatives as an overlay if you don't know how to identify the underlying risk. So what are we going to do to address this? And really what we are interested in here is to provide a kind of a set of tools that will allow investors to address these exposures, to target them effectively. So we're looking at 3 improvements, if you will, so 3 ingredients to actually achieve that. And those are listed here on this slide. So importantly, we're not going to present you kind of a magic computational technique that will deal with all of these issues, right? So actually we need to go beyond simply, improvements in statistics and quantitative methodology to actually be able to address these issues. And maybe that was kind of the comment that, I got when we started this project that, well, it's, you cannot expect that by having a better statistical model that you're going to somehow be able to pin down these exposures where a lot of people have failed. So it's clearly important to go beyond simply computational techniques. So we're doing three things. So the first one is really about the economics of the problem. So we're not trying to pin down exposures to very slow-moving macro fundamentals like, say, realized inflation or GDP growth or things like that. We're actually going to look at forward-looking economic variables. That's important because these forward-looking variables, they actually reflect expectations that investors have about the macroeconomy. And when these expectations change, well, you expect actually asset prices to react to that. Very different story for things like GDP, that is just too backward-looking to actually get any reliable measurement. The second step is precisely about statistics. So we're also making sure that we have robust statistical tools that allow us to improve upon measurement. And then the final step is really about kind of suitable design of such a strategy. So what we're doing is, so given that we use macro variables that are economically sensible, right, in the sense that you can expect that these variables are reflected in stock returns, then we're using robust statistics. But then the last step is still about design of these tools. So instead of using these off-the-shelf building blocks, we're actually creating dedicated building blocks. So it wouldn't actually be very useful, to start with the right economics, have kind of reliable measurements, and have the right statistical tools, and then kind of use building blocks that are actually not really designed for this specific purpose. And so we actually need all these three ingredients to actually achieve that result of a reliable macro exposures. So let me just explain these steps in turn, and then so this is kind of an overview of the methodology, and then I will hand over to Mikheil to actually document some of the results that we achieve with that methodology. So the first question, okay, so what are these forward-looking macro variables? And again, this is a crucial step. So again, we wouldn't expect that, no matter how sophisticated the technique, we wouldn't, just from economic principles, we wouldn't expect to be able to measure reliably exposure to, say, GDP growth. It's just too backward-looking. So we're looking at these forward-looking variables. So we have break-even inflation, the short rate, the term spread, and the credit spread. So all of these are actually extracted from traded assets, and they reflect investors' expectations about some of these quantities. So, for example, break-even inflation clearly is driven by both inflation expectations and by inflation risk premia, and depending on these two, break-even inflation levels will vary, and they're very kind of fast-moving and forward-looking. The credit spread, for example, you could take that as another example. So the credit spread, of course, we know is a strong, kind of predictor of recessions. So if there's an increasing credit spread, that clearly signals that investors expect a worsening outlook for the macroeconomy. That's why a spread increase. Equivalently, you could also say credit spread kind of signals a rising risk aversion of investors. And so, macro variable like the credit spread, it's really able to pick up changes in expectations quite fast. And in that sense, these variables are very different from kind of the typical macro fundamentals. Let me just show you two very simple illustrations to give you a bit of a taste, for how these, a bit of a taste of how these macro variables behave and why they're useful in our context. So the important claim that we make, which is not controversial, is that these variables, they are forward-looking, and you can see that illustrated here with the relationship between the term spread and the economic growth, right? So what you look at here is, so we plot the 2-year ahead economic growth, approximated by growth in industrial production, against the current level of the term spread. And you see that there's some strong correlation there. So it just means that when actually the term spread tends to be high, that basically means that there's positive expectations on economic growth, and so economic growth will actually tend to be high going forward. So that's why, of course, asset prices will reflect this change in expectations. And so looking at industrial production directly leads you actually to kind of failure to establish a link with stock returns, right? Because stock returns already have built in this forward-looking information. So this is just to show the forward-looking nature of these macro variables that we use. Now, another important point is that, of course, we're going to look at the innovations or the surprises in these macro variables instead of looking at simply kind of the level of inflation or the level of the term spread. So we're actually going to look at the innovation, and this is exactly for the same reason. So we will be able to measure how equity portfolios behave with respect to macro variables and macro conditions only when we look at innovations, right? So if, for example, the inflation, which is shown here, is consistently high or consistently low, that doesn't have any impact on stock returns because it'll already build into prices. So if inflation stays high for 10 years, being in a high inflation regime is not going to influence stock returns, let's say between year 5 and year 10. So stock returns are, however, influenced by these changes when there's innovations, when there's news that arrives, and here we're measuring these innovations. So you can simply look at kind of the change in this macro variable. You could have other econometric techniques to extract innovations. And you see here an illustration with a break-even inflation. So it's interesting to look at break-even inflation around the global financial crisis in 2008, 2009. So look at the levels, right? The levels are the black line here in this graph. So inflation was, moderately high, say around 2.5%, going up to the financial crisis. And then what happened during the severe financial crisis, break-even inflation actually went to almost zero. And then inflation kind of normalized up to this, by about mid to end of 2009, after, the bailouts and after it was clear that, this crisis is actually being managed and is not going to, it's not leading actually to total collapse of the global financial system. Now, if you look at these inflation levels, so you would see, for example, that around early 2009, inflation levels were quite low. But look at the innovations. Well, the surprises are actually positive. Ever going out of these very severe financial crisis at the end of 2008, you have lots of positive innovations. And of course, that's what would have expected, that's what influenced stock returns, right? Around that time, that actually there was these positive shocks to inflation, that expectations about inflation increased. And the fact that actually inflation was at a low level, that was not really relevant, right? So the news was that inflation was actually picking up again, and stock prices will react to that, right? So it's very kind of just common sense that it'll be the surprises that matter. Now, how do we actually measure this? So very simply, what we're interested in is, macro exposure is defined as the return sensitivity of a given stock to a given macro variable. And so this is we just measure the linear dependency of stock returns over time on this macro variable. We actually control for the market exposure. So simply, we don't actually want to, pick up some kind of polluting, confounding effect from differences that stocks have in terms of exposure to the market. We just want to kind of extract and kind of isolate the macro sensitivity. Now, we do that while taking care of robustness in our statistical measurement. We do three things. I will just give you the main idea without going into the details. So the first important thing that we do is that we try to be as precise as possible by actually increasing the sample size. So a lot of measurement of exposures in practice and in research is actually done with quite low frequency variables, so say monthly data, and then people look at maybe a fixed window, so-called rolling windows, and so that actually leaves you with not a lot of data points. Instead, what we do is we actually go at a much higher frequency, and we also extend that time window to make sure that we are able to capture and to use all the available information. We also then account for the time varying dynamics of weights. So the way in which shocks to a macro variable like inflation influence stock returns, is of course not constant. So the weights that we need to give to these different shocks over time has to be dynamic, and so we're using an approach that allows us to do that. We're looking at a very long sample of 20 years, but then we're kind of making sure that the most recent observations they are just overweighted, so that we account for these differences in weights. And finally, we also account for the estimation uncertainty. So we could just take the estimated exposure at face value, but we also have to account for the fact that if you look at two stocks, right, they might have the same exposure in a given sample, but that exposure could be estimated with different degrees of uncertainty. So we're also looking at statistical error in these measured exposures, and we account for that. So this is called Bayesian shrinkage. So basically, we're just going to downweight the statistical estimate if that estimate is highly uncertain, and we're basically going to say, well, that stock, the statistical information is not very reliable, so we just think that stock will behave much more than the average stock than actually what the statistical estimate suggests. And so these are the different ingredients. So we're really making sure that we have these forward-looking variables, and we're applying robust techniques to actually pin down the exposure that stocks have to these variables. So the question then is, what results do we get with this type of approach? And I'll leave the floor to my co-author, Mikheil Esakia, to explain that in detail.
Thank you, Felix. So let me go through the results, and we basically want to show different things, but I'm going to start with looking at or kind of assessing how our exposure estimates perform. So we basically want to see how reliable these estimates are. And the way we do this is we follow a pretty simple approach, and we construct what we call ex-ante mimicking portfolio. So this is the same portfolio that basically Felix mentioned earlier with inflation and growth. But now what we do is we estimate exposure to the 4 macro variables that we use, and then we create portfolios that would take a long position in stocks with the high estimated exposures, and we take a short position in stocks with the low estimated exposures. So since ex ante, these portfolios should have a positive exposure, we would expect that going out of sample, we maintain this positive exposure, and that's what we would look at, of course, if the exposures are reliable. So that's what we will do, and in addition, we will report results for different approaches of estimating exposures, just to give an idea how our approach improves upon the different approaches and what are the results of applying each of the statistical techniques that Felix just mentioned. So let me go to results here, and here basically what you see is the exposure out of sample for 4 different mimicking portfolios. And in the first row, you would see the case where we apply a naive estimation technique. So this is an estimation approach that is the most common in academic papers, and it basically uses standard OLS regression on 5 years of monthly data. So basically what this methodology leads to is mostly positive and statistically significant exposures to the macro variables. And you can see that with t-test reported in the brackets, most of these exposures are significant. But there's exception, which is credit spread, where we see that statistically we cannot say reliably that this exposure is distinguishable from zero. Now, in the following rows, what we do is we show step by step what happens if we first change the frequency from monthly to weekly. That's the second row. Then in third row, we also would apply this dynamic weighting to be sure that we're capturing the time varying nature of the exposures. And in the last row, what we do is we account for uncertainty. Okay, so we apply the Bayesian shrinkage. And if you check, each of the steps provide incremental improvements in terms of the magnitude of the exposures, as well as the statistical significance that we can assess based on the t-stats. The thing is, if you compare the first row, which is the naive, commonly used approach, to the approach that we propose in the last row, you see that the exposures increase substantially, goes from 1.7 to around 2.45 on average, and we also see large improvement in terms of t-statistics, which goes from 2.5 to 4.4 on average. Well, this clearly is a big improvement, but what's also important is that if you look at the individual macro variables or the mimicking portfolios of these macro variables, you see that the improvement is pretty consistent across all the variables, and you see that exposures to these macro risks are significant and higher than t-stats are higher than around 3.4 at least. So this is a pretty strong improvement. One thing that is important to note is that this kind of improvements that we show on this table is not really the total benefits that our proposed approach delivers, because remember that people would mostly rely, as Felix mentioned, and he also showed some evidence, would rely on the variables quite often like consumer price index or realized production growth. And when you use variables like this, you don't get good results, even if you use naive estimation approach. But here we see that we already have some success, because what we did was we now changed the variables, and now we use the ones that are forward-looking and that capture expectations, which means we're now relying on the information which is more relevant to the stocks. And this is another important aspect of our approach, which allows us to establish this link between stock returns and macro variables. Now, let me go to the next set of results, where I want to show you or discuss the results of the long-only portfolios. So now we move to more useful case or interesting case, where we look at actually long-only portfolios that are easy to replicate and that are easy to trade, basically. So we would stick with the methodology, basically, that we use for the mimicking portfolios, but now we would look at the long and the short parts of the mimicking portfolio separately. So that would give us two portfolios for each macro variable, one that will target a positive exposure and another one that will target a negative exposure. And for the comparison, we would like to see how this approach of selecting stocks and building portfolios from the stock information would compare with other popular approaches, like allocating across factors or sectors, for example. And we do this by using the same robust macro estimates that we use to construct the portfolios, but the difference is now we would make a selection out of the candidate factors, which are some widely accepted equity style factors like size, value, momentum, or we would make a selection out of 10 sectors. Basically, we'll select 3 out of 10 sectors, and we'll see if it provides reliable results out of sample. So the results on the next slide exactly show this, and we have 3 set of results here, or you can call it panels, where we focus on the dedicated macro portfolios, factor allocations, and sector allocations separately. So starting with the dedicated approach, you see that these portfolios are able to deliver the exposures that they target. So if we look at macro exposure plus portfolios, which target positive exposure to the given macro variable, you see that these exposures are positive for all the variables. And we observe exactly the same thing for the portfolios that target negative exposures. In addition, these exposures are highly significant, speaking statistically, which means that these exposures are reliable, and all 8 portfolios were able to deliver what they promise, if you will. Now, the story is pretty different if you look at factor allocation or even sector allocation. Even though you see that most of the time the exposures have the right direction or a right sign, you see that quite often they lack statistical significance, which means that these could be just a result of a sample, these results should be highly dependent on sample. And if you look on average, what you get is around 0 exposure in most of the cases. So we highlighted here this in green. So in green we only we emphasize the exposures that are significant, and as you see, for factor allocations, there's only 3 such exposure out of 8, and for sector allocations, there's only 4 out of 8, which means that even though sometimes these approaches or using building blocks like factors or sectors may give you desired exposure, sometimes they may not, and they clearly lack consistency. Now, this is clearly important, because imagine if you were an investor who has a great model and can predict where credit spread goes, and if you can do that, if you can correctly guess multiple times in a row, if you use factors or sectors to somehow benefit from these insights, you still won't be able to get anything in terms of benefits, because these building blocks simply do not allow you to gain consistent and reliable exposure out of sample. Speaking of taking benefits, I want to move now to the returns, which is exactly like the result of these macro exposures of our dedicated portfolios that kind of translate into a pretty strong return sensitivity. So what we show here is we show market adjusted returns for each of these 8 portfolios in 2 different conditions. One when the surprise in the given macro variable is positive, and one when it's negative. So if you focus on the 2 bars on the right, for example, which corresponds to conditional returns of inflation minus, you see that the red bar, which corresponds to returns in times of negative surprises in inflation, is around 10% annual, which means that inflation minus portfolio on average outperformed the market by 10% annual when the surprises in expected inflation was negative. And you can see that for all the variables, this pattern persists, and we're able to achieve the desired sensitivity of these returns for all the variables. Though you would notice that the magnitude is quite different sometimes for different strategies, you would also see that this magnitude of the returns are mostly above 3-4% per year, which economically speaking is still quite important. So speaking of conditional returns, the last thing that I wanted to share is the long-term unconditional performance. This is something which is pretty important, because let's say you're able to kind of hedge or gain desired macro exposure with your equity, but then the question is, do you have to pay for this? Does this come with a cost? So this is kind of the question that we give kind of a brief overview here in this set of results, and clearly this question may require further investigation, and this is kind of ongoing research for us. But what we wanted to show here is kind of an overview and kind of an idea of what this cost may look like, given the abilities or the macro exposures that these strategies can provide. So in this table, what we report is different performance measures such as standalone annualized returns, Sharpe ratios, and multi-factor alphas, which is return that is not explained by common equity style factors. And we report these measures net of transaction costs. So we account for the trading cost of individual stocks at each point in time using pretty accurate proxies of the effective bid-ask spread. And what we find in general here is that none of the strategies seem to bear any kind of cost in terms of the performance. So, for example, if you look at Sharpe ratios, they're pretty similar to the one obtained by the broad U.S. market portfolio. And if you look at the statistical significance as well, there is nothing except for credit spread, which seems to provide slightly improved Sharpe ratio. We also don't find anything in terms of multi-factor alpha. So this clearly states that over this sample, using strategies like this does not really seem to bear any kind of performance cost to investors, and they perform on average pretty similar to the market equity US broad market portfolio. And we have the same results for the inflation. We just report this a bit separately because of some small differences in time period due to the data limitations on break-even inflation. So I think we can conclude now. So we've seen that it's possible to measure macro exposures reliably, and we did this on stock level, and this allowed us to create portfolios that came with pretty strong exposures out of sample. And we also have seen that this dedicated approach of building portfolios from the firm level information is really superior to selecting superior to allocating to the existing building blocks like sectors or factors. And we saw that the dedicated portfolios come consistently with pretty strong exposures when we go out of sample. Our strategies are also transparent and systematic, and this is clearly an advantage over some of the existing products that are managed in a discretionary way. So as one of the referees of the paper mentioned, these strategies can be used as a blueprint that investors can rely on, whether for their risk management purposes or whether for expressing their active views in their equity portfolio. So at Scientific Beta, we build on this methodology, and we have two series of macro indices. The first one is designed to capture and provide strong out-of-sample exposures, but with the consideration of the tracking error. So these strategies are pretty similar to the market on average, but they provide pretty strong sensitivity to the given macroeconomic risks. And the second series of indices that we have is more like concentrated versions, which achieve much stronger exposures to the macro variables, but of course they come at a higher cost in terms of tracking error and deviations from the market portfolio. Thank you for your attention.